Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. And just a quick favor to ask before we get started in today's episode. If you do enjoy the podcast, please share it. Please rate it on the platform that you listen to. It does help me with the ratings and help me spread the word, and I'd greatly appreciate it. Thank you. So let's get into today's episode then. It's obviously with the end of the financial year fast approaching. It's the time of year that we start talking to clients, or we've already been talking to clients about end of year tax planning. So I thought I'd just run through almost like a little bit of a checklist of some of the things that you might want to think about in terms of actions that you might need to take before 30 June comes around, which, to be honest, is only 5 weeks away. So the first step is really you've got to start by ascertaining what your tax position might be for the 23-24 financial year. Now, of course, the year isn't closed yet, so we still need to make some estimations regarding income and tax deductions for the rest of the year, but you've got to just do your best and hopefully estimate it as much as possible. That includes thinking about any investment income that you've earned, kind of annualizing that, including property income and expenses. You know, your managing agent should be able to give you a summary for each property regarding total income and expenses, and again, you can kind of extrapolate that over 12 months. And the same with any employment income and so forth, and super contributions, so forth. So that's the first step is, let's ask ourselves, what position will we be in? And then that'll dictate really, how proactive you need to be with respect to tax planning. So for example, if you are just over the highest or the next tax bracket, let's say the highest marginal rate kicks in at 180,000 this financial year, next financial year changes to 190, but 180 this year. So if your income is 185, for example, that's what you expect it to be. Well, you want to try and do everything possible to find some tax deductions to get you below the 180 mark. If you are well and truly past the 180 mark, you're well and truly into that top tax bracket, well, of course, you want to maximize every deduction, but whether you do that this year or next year, assuming you don't expect your income to change, isn't such a big deal. Which is a good segue into my next point, which is you've got to think about what will your income be next year? What do you expect it to be? As in, do you expect it to be similar to what it is this year? Because if you think it's going to be lower, for instance, given the tax rates are changing, a tax deduction this year might be worth a lot more than what it will be worth next year, again, depending on what those income components are. So you've got to estimate what will your tax position be this year? What do you think it's going to be next year? And then again, that'll dictate, whether you want to defer tax deductions to next year or maximize them all in this financial year. Okay, so let's talk about some things that you might want to consider with respect to reducing your tax liability this financial year. So the first one, and the really common one, is concessional superannuation contributions, or sometimes called personal superannuation contributions. They're the contributions that you claim a tax deduction for. Everyone has a cap of up to $27,500 that they can contribute each year. Included in that cap, your superannuation guarantee employer contributions, so what the mandated contributions that your employer contributes, as well as any salary sacrifice contributions. But if you add those figures together, you've got to work out, look at your pay slip, or if you're self-employed, ask your accountant how much you've contributed year to date, and then annualize it, of course, to account for June contributions, May and June contributions. If you expect that you're not going to utilize the cap, so that the total amount is less than $27,500, well, you might want to think about, whether you make additional personal contributions. You can do that through salary sacrificing if you're an employee, but probably the easiest way to do it is just making a personal contribution, which means transferring from your savings account into your super account. Now, if you do that, you've got to complete a form called a notice of intent to claim a personal tax deduction. It's a bit of a mouthful, but you can just Google that, notice of intent to claim, and then just put your super fund behind it, like Australian Super, for instance, and it'll take you to the page where that form exists. And essentially what you've then got to do is notify the super fund that this is a concessional contribution, because most super funds will treat all contributions as non-concessional. That is, you're not going to claim a tax deduction until you notify them otherwise. It's good to complete that notice of intent to claim as soon as you make the contribution. Firstly, so you don't forget to complete it, but also if you make any changes to your account, like roll out some money to pay for an insurance premium, for example, well, then you lose the ability to go back and change previous contributions. Or if you switch super or do something like that, you potentially deny yourself a tax deduction in the future. So it's certainly good to do that notice of intent to claim straight away. Now, your superannuation contributions have to be credited to your account for you to be able to claim a tax deduction this year. So most super funds have a cutoff date around about 20 June, I think, circa that date, which means that if you're going to make additional super contributions, try and make them in the first half of June. Don't leave it until the second half of June. Now, if your taxable income or adjusted taxable income is above $250,000, so let's make that really simple. If you're an employee or you self-employed and you pay yourself more than $250,000, this is going to apply to you, which is what's called Div 293 tax, and essentially means that your contributions, your super contributions, are taxed at 30% instead of 15%. Now, the ATO doesn't know yet whether you have your adjustable taxable income is above 250, so you won't get a bill for Div 293 tax until you lodge your 24 tax return, which might not be until March or May 2025, of course. But once you lodge that tax return, you'll get a bill for Div 293 tax, which will be equal to 15% of whatever concessional contributions that you've made. So it could be up to $4,125 to be exact, which is the maximum bill. You can pay that additional tax either from your super or you can pay it personally. I tend to recommend paying it personally just to preserve as much money inside super as much as possible. Now, if you are just on the cusp of $250,000, well, you might want to consider whether you can find some tax deductions to get yourself under that $250,000 to avoid that additional 15% tax. So for instance, let's say your salary is $255,000. In that case, you would be liable for Div 293 tax. However, if you donated $5,001 to charity, it would reduce your adjusted taxable income to below $250,000. Now that $5,000 donation is going to cost you $2,650 after tax, but it will save you $4,125 from Div 293 tax. So therefore, you're circa $1,500 better off. It's pretty niche, but if those people that are just around that 250 mark, think about, whatever deductions that aren't included in adjustable taxable income. Adjustable taxable income adds back investment losses. So, property deductions and so forth don't help you there. It's really, donations are the ones that kind of stand out. And so not only do you save yourself $1,500, but of course you help a charity in that process. Now, a few years ago, the government changed the rules around super, which allowed you to utilize concessional contribution caps up to 5 years in the past if you hadn't fully utilized those caps in previous financial years. So the first financial year you're able to do that was 2018-19. And because that comes to its 5-year anniversary this year in regards to this financial year, it is the last time that you'll be able to utilize any unused caps from 2018-2019. So it's kind of a bit of a use it or lose it scenario. If you want to find out whether you have any unutilized caps, the best way to do that is log into your MyGov account, make sure it's linked to the ATO, and then if it is, you can just Google how to find those unused caps, but you can find it through MyGov. Now, for you to be able to utilize that 2018-19 cap, you've first got to fully utilize this year's cap, because how it works is all contributions go to the current year cap. Once we've exceeded that cap, then they'll automatically take up any unused caps in previous years. So you've got to be contributing the 27.5 this year to be able to utilize the 2018-19 unused caps. But think very carefully about it. As I said, if you don't use it this year, it's gone forever. Similarly, you could only use unused caps up to 5 years previous if your balance at the beginning of the financial year is less than $500,000. So for example, if your super balance at the beginning of this financial year was less than $500,000, but has since exceeded that $500,000 balance, so on 1 July 2024, if you expect your super to be worth more than $500,000, then this year, 23-24, will be the last year you'll be able to utilize any unused or use any unused caps in terms of super contribution caps. And so you should then work out, whether you have any caps, if you fall into this category, and if so, consider whether you want to utilize them, because if you don't use them this year, you might not be able to use them next year. Similarly, in terms of utilizing super contribution caps to reduce taxable income this year, another strategy is to decide not to use them. So for instance, if you expect your income to be much higher next year, you might decide, what, I'm not going to use any of these unutilized caps. I'll carry them over to next year. Now, of course, you want to make sure that total super balance is going to be less than 500,000 next year as well, as on 1 July 24, and you will still lose the 18-19 cap. So again, it depends on how much that is. If that's not material, it's not a big deal. But for some clients, we've had that discussion and said to them, you know what, let's not use the cap. We'll use it next year in order to reduce tax in that year. And for those clients, for example, might be expecting to make a capital gain in that next financial year. So we want to use the caps at that point to reduce the capital gains tax. Okay, some additional little tips if your spouse's income is low. So if it's under $37,000, you can make what's called a spousal contribution, which is essentially a non-concessional after-tax contribution of up to $3,000 into their account. And if you do that, you will receive a $540 tax offset. So it's not a tax deduction, it's an offset, which means it reduces your tax liability by $540,000, and you get to boost your spouse's super by $3,000. In addition, you could go for government co-contributions. So if your spouse's income is less than $43,000, nearly $43,500, they can make a non-concessional contribution to their own super of up to $1,000, and they'll be entitled to receive a government co-contribution of $500. So these things aren't going to change your life very much, but if your spouse's income is low, they're certainly worth taking up. So if your strategy is to get more money inside super, and this tip really is a end of financial year tax planning tip, but it's not really around minimizing tax. It's really around getting as much money into super. So let's say that you want to get as much money into super as possible this year because you've sold an investment property or received inheritance, whatever it might be. If your total super balance is less than 1.68 million, you are able to make either one non-concessional contribution each year, and the cap this year is 110,000. Next year that cap increases to 120, or you're able to bring forward 3 years of contributions into one. So to maximize the amount that I can get into super, what I would do is I would make one non-concessional contribution this year just up to the cap. So put 110,000 into super before 30 June 24, and then on 1 July 24, the next financial year, I would make 3 years of non-concessional contribution caps in that particular year. So 3 times $120,000 being the higher new cap, which is $360,000. So essentially that allows you over June and July to move $470,000 into super. So you can kind of sort of play the game in terms of bridging or over 2 financial years to try and get more money into super. Now, it's not going to help you save any tax per se this financial year, but it does get more money inside super, and up to $1.9 million is tax-free. So it will help you save a lot of tax in the future. Now, it's been really well publicised that tax rates are changing next financial year. So probably the big change is the marginal rate doesn't kick in until $190,000 as opposed to $180,000 this year, but also the tax rate and bands shift out a little bit. Essentially, you'll save about 1.5% in tax up to the top marginal rate, and then that saving gets diluted the more money that you have over and above the top marginal rate. So it's nice, it's a positive outcome, but again, for most people, not necessarily going to change their life. I guess if your income is between 180 and 190, it might then give rise to more specific planning measures for you this year. So, if it's between 180 and 190, what your aim would be is to try and shift as many tax deductions into this year, even if it means you're going to forego a tax deduction next year, just because tax deductions this year save you 47%, whereas next year they won't. They'll save you 39%. So tax rates don't change that often, so it's a pretty unique situation, but it's just something to think about if you're certainly in that bracket. So if your goal is to reduce your taxable income this year, you've got to think about all the expenses that you can possibly pay before 30 June. Can you pay insurance premiums in advance, those sorts of things? If you're planning to make repairs to any investment properties, aim to pay for them and finish them before 30 June. For example, sometimes people contemplate paying interest in advance. So there's mortgage products out there that allow you to pay 12 months of interest in advance. They aren't that appealing at the moment in terms of the interest rates that they charge. So unless you are sure you're going to make a significant tax saving as a result of doing that, I probably advise don't worry about interest in advance this year. Another tip for anyone that has income in a family trust that has already exceeded the top marginal tax rate outside of that family trust. So let's say we've got a family trust and we've got 2 primary beneficiaries being two spouses, and both spouses, their taxable income is above $180,000. If we distribute money from that family trust to those 2 spouses, they're going to pay 47% in tax, being the highest marginal tax rate. If the trust doesn't make an election to distribute those monies, so they become undistributed income, the the trust or the trustee, in fact, is actually taxed on that income at the top marginal rate, excluding the Medicare levy. So they'll pay 45% tax. So a little tip for people that, particularly self-employed, that have business income coming through a family trust, one option is to not actually distribute that income to any individuals and then pay 45% as opposed to 47%. Now, you'd only do that if you actually need to get the money out of the trust and out of a corporate environment. So that is if you're putting it towards living expenses, repaying a loan, those sorts of things, a home loan. Alternatively, if you don't need to do that, then a better option is to distribute it into a corporate beneficiary, into a company, an investment company. But for those people that actually need to use the cash for personal purposes, that can be a good strategy. Now, of course, a lot of these tips are related to individuals. If you're a business, could be a whole host of tax planning opportunities for you. And of course, you just can't discuss it in this forum because every business structure is different, every industry is different. But certainly you should be speaking to your holistic accountant if you're in business to work out, if there's anything that you need to do. To finish off, we've got sort of two administrative matters that you probably need to think about before 30 June. The first one is if you do have a family trust, by law, you have to complete and sign family trust distribution resolution minutes before 30 June, which is just setting out how you're going to distribute the trust taxable income this year. And the other thing, which I've already previously mentioned, is the notice of intent to claim. You don't necessarily have to do that before 30 June, but as I said, I like to complete those forms as soon as you make the contribution. You don't need to do that if you've got a self-managed super fund. It's really just if you've got a wrap platform like Macquarie or an industry super fund. Now, just to finish off, I know it's a bit of a long-winded episode this week and apologise for that, but just to finish off, throughout this process, you might find that there are opportunities to actually improve your position. That you might not be able to do that right here and now and before 30 June, of course, but you might find, oh, look, I'm paying too much tax, or this is tax ineffective or inefficient. I actually think tax planning should be done twice a year, really at the end of the year, which is what we're talking about today, and at the beginning of the financial year, because if there's things that you want to do or put in place or change, it's typically too late to change them for the 23-24 financial year, but you hopefully then can enact some changes over the next few months so that you improve your position for 24-25. And so that's the final thought that I'd leave you with is as you go through these things, it's also good to think about, well, what do you want to do in 24-25 so that 12 months from now, hopefully you're in a different tax position. Finally, of course, none of this is specific advice. Tax advice are very intricate. There's always exceptions, to every rule. So don't act on this podcast alone, of course. You need to get your personal tax advice and personal financial advice. But hopefully it gives you some tips of just some things to think about before 30 June. Okay, that's it for me for this week. Until next week, bye for now.